Here we go. So core trading strategy, trading the trend. It isn't rocket science because I could do it and I'm not a rocket scientist, unlike somebody. Okay. So this is a strategy that I used part-time first. Okay. So I was trading this in Afghanistan. Okay. I was a contractor in Afghanistan and I would literally work all day, markets closed, come back, do my stuff, analysis, put my entries together, fire and forget, come back the next day and do the same thing. Okay. I did it in the jungles of Africa, big 5-meter dish, really slow internet. Okay. Used to take me an hour and a half just to do my analysis at the end of the day and then do it again. And then I obviously then started trading other people's money and you know the rest. So we have to do the risk disclaimer, I'm afraid. I'll give you a second to read that. You're all big boys and girls, okay? So there's a lot of risk, especially in today's markets with swing trading or short-term trading or options trading and futures trading. So hopefully you've read that now. There are all the disclaimers on tradethefifth.com as well. Right, so some of this first part, some of you have seen already in the boot camps for the software, but I wanted a bit of background to that first, and then we'll start to go on to the new stuff about price action volume and all that sort of thing. So a trend is simply herd mentality, okay? That's all it is. So the books say herd mentality describes a behavior in which people act the same way or adopt similar behavior as the people around them, often sort of ignoring their own feelings in the process. So can you give me any examples about herd mentality right now? Or recently in the US, herd mentality. Shall I just name them Mr. Trump? Yeah? Do you think that was herd mentality that got him into office? Yeah, because people started talking about something that people liked, and then other people started talking to other people, and all of a sudden, ignoring their own feelings in the process, that sounded good. And all of a sudden, you've got a TV star that's a president, okay? That's herd mentality. Yeah. So you've probably heard your parents or teacher ask you something, okay? In England, this is a saying, okay? This is a saying. If your friends jumped off a cliff, would you do it too? Or my mum used to say, if your brother jumped into the fire, would you do it too? Yeah? So of course you wouldn't do that. It's a little bit insane, but you know, most people are strong and independent thinkers. So why would you do it is the question. Why would you do it? Okay, I've actually done this, by the way. Yeah, and I will never do it again. Okay. Yeah. No, there was because I've done a lot of parachuting before. You've got a parachute as well, just in case things go wrong, and you still pull it at the end anyway. But it is pretty awesome. Yeah, but I'll never do it again because it's not like jumping out of an airplane because you're moving a lot faster. But it's literally you just go like that and you go to the side. It's really, really cool. That's why I chose this GIF. It's pretty cool. So imagine if your friends weren't jumping off a cliff, okay? Because not everybody does that. Instead, what if they said to you, you know, they're buying shares in the latest tech company about radar, okay? You want to get into this, it's really good, okay? And then the next week you see them for a beer, stock price has gone up, and they keep saying, I'm buying some more, okay? And then you go home and think, you know what? I'll put a couple of thousand in that stock. And you tell somebody else. And all of a sudden this tech stock, this story starts to breed. Okay, and people think, oh, I've got to get in it, I've got to get in it, I can't lose. That fear of loss that drives that mentality to buy more shares. Okay, and that's the herd mentality. So again, even if you hold off, say it's gone up from $10 to $15, that's a big rise. And if you've been holding off that, it's not a question of if you're going to do it, it's when, because you've seen that massive rise. And it's that mentality that we see in the markets. So, you know, how's this going to help with your trading strategy? So in reality, me, you, and everybody else, we don't move the market. Okay, it's institutional traders. So this herd mentality is really, really strong for institutional traders because they are human beings. Okay, they're not robots, they're not algos, because the algos are programmed by human beings, and those algos are programmed by behavior that is learnt from the markets, how people see a stock going from $10 to $11 to $12 and all this machine learning and all that sort of stuff. At the end of the day, it's a human being interpreting that behavior and putting it into algorithm. Okay, the thing with an algorithm, there's no emotion, but what they've done is programmed the emotional response to the markets as an algorithm. So, you know, there's still emotion in there, really. Okay, so what? Okay, so the bulls. Let's talk about trend behavior for the bulls. So this follows a story, if you like. So when certain things happen in institutional traders, there's a flow that happens that causes this herd mentality. So when an institutional trader sees a value in a stock, you know, he buys a sizable amount of that stock. So me and you, if we buy Amazon, we might buy 10 shares, yeah, at 20 grand. They'll buy 10,000 shares, okay? So they're going to move the market. We can't, even as a collective, even if in 2 years' time we had a signal service of 1,000 people, for example, and I said, right, let's all buy Amazon now, okay? 1,000 people, even if they just bought 2 shares each, is only 2,000 shares. You're not going to move the market. You really, really do need some big weight, billion-dollar accounts to really start to move the market. So other traders start to take note of that. So, and after similar analysis, and you see those big buys, it makes the price start to move up because nobody wants to sell at that low price anymore. Yeah. When somebody wants to buy it, no one wants to sell at that price. They want to make a little bit more. So the brokers have to put the price up so somebody else is prepared to sell. You can't just say, I want to buy 50,000 Amazon shares. If there's no one prepared to sell at that price, the broker's job is to put it up until someone's prepared to sell it. And that's how stock prices move up. So as momentum grows and more traders don't want to be left out, fear of loss again, the price starts to trend up higher. And that's what we just talked about there, is that, you know, I want to buy some shares of Apple. No one prepared to sell it at that price. The broker gets the order, he can't fill it, so what does he do? He puts the price up. Is somebody else prepared to sell at that price? No. Puts the price up again, and all of a sudden someone's prepared to sell at that price, so the buyer gets those shares, and that's when you see those gaps in stocks as well. And that's how that momentum starts to build. Because a lot of the time you'll get institutions that say got 1 million shares of Apple or 10 million shares of Apple. And at some stage, they bought some of those really low, okay? And they're not prepared to sell right now, but they want to take some of their position off. If the broker keeps putting that up and they see momentum, think, I'm going to get rid of some of my shares. They'll take 100,000 off from the ones they really bought really low, and they'll sell them. And then somebody will buy them at that price. And then somebody thinks, oh, this is going up now. I need to get in. I want to buy some. But no one's prepared to sell, so the broker has to put the price up again. And then they buy it, and then it just keeps going like this. And that herd mentality takes over. No, I don't want to move. I don't want to lose out. And then the guy that sold 100,000 shares a while ago, still in profit with his share, thinks, oh, shit, shouldn't have got out. What do? I need to buy some shares. It just keeps going. And it's that sort of herd mentality that really drives markets up or down, okay? So it doesn't last forever. These sort of human institutional traders, if you like, who got in early, start to take profit at some stage. They're human beings after all, okay? All institutional traders. A lot of firms in London now, they don't give bonuses. They just give massive salaries, okay? But I think in the US, still it's driven by bonuses. So you've got to think an institutional trader that has a responsibility for, I don't know, $500 million, okay? He's got a certain amount of trades open. It's coming up to the end of the quarter. His wife's nagging him for a new bloody bracelet or something like that, or a new car, and the salary's not quite covering it. What I've got to do, I've got to take some profit off. I've got to earn some more money for the company, so they'll give me a bigger bonus. Yeah, that's going off in his head. Nobody else knows in that institution that he's thinking that, but he's got those outside influences making him want to do that. And if he's had a good run on Apple, and he wants to take half his position off, which is a big position because I don't know, he's getting married or something like that, he'll sell that block of shares, and that could start the pullback that we all look for. Okay, so for the bears. So again, when some of those early buyers start to take some of the profits, they start to reduce their position sizes, and that can start the ball rolling, if you like. So some of the other institutional traders start to see this. Why has that guy just offloaded 1 million shares of Apple? Something's going off. He knows something I don't. I'm in profit now. I've had a performance review. It's not very good. I need to get some profit on the board. Didn't make much profit last quarter. Lots of stuff going off in his mind. And all of a sudden he thinks, yeah, I'm going to take profit. I'm going to take hold of the position. So at a certain point, sort of those traders sort of get in the herd, really, get in the herd move. Find themselves at a price lower than their original entry sometimes. So, for me, when I'm blend investing, I wait for pullbacks and I get in, but sometimes a pullback might be deeper than one of my entries. Okay, so then there's a big decision to make. Do you get out? Okay. So it's a critical sort of time in trend behavior when those pullbacks occur and you're in a position that's actually in a loss-making position now. So you've got to have a lot of external influence fundamental wise that you're going to think, well, that stock's good. I'm going to hold it. I'm in loss at the moment. I'm going to hold it. Yeah. Or shit, I'm going to get out, and that's the panic button. And that's when you start to see what happened in Apple recently. The bad news, a rumor that one of the suppliers' orders has been cut. Okay. We didn't know the whole story, but institutional traders start to panic. So what do? They start selling off. When you saw Apple go boom, 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 people start to panic. You're in a slight loss-making position. I'll get out. I'll wait for the dust to settle. And that's what happened. When in reality, who's to say that Apple didn't go to another supplier to get that same widget? You don't know. You only know one side of the story, but the herd reacted to that story because that supplier said Apple's cut their order. So all of a sudden, the herd think they're in trouble. I'm going to sell. I'm going to take my profits. But it's not just one that did that. It's more and more and more, and it went down. Okay, so the pullback. So if those slight loss-making position traders still see strong growth potential in the stock, they're going to stay in it, yeah? They're going to stay strong. They're going to switch the computer off. They're going to go and have a coffee, yeah? So they buy more shares at a lower price, thus lowering their average holding price. So if we buy shares in X company at $100 and it moves down to $50, okay? We've got a lot of balls to let it move down that far, but okay, it does move down. So then all of a sudden you think, I still feel strongly about this stock. It looks good. This is really good value now. I'll buy an equal amount of shares at $50. So their average holding price now is 75. Okay, from a trades management point of view, even if you're not going to look for long-term growth in this stock, to get back to 75 to break even is a lot easier to get to 100 break even. Okay, so sometimes as a trade management strategy, you're going to get in a lower price, lower your average holding price with a view in your head when it does spike up on earnings or something like that, gets back to break even, I'm getting out. Or on the other hand, you're going to have that longer term view, get those prices at a lower, those shares at a lower price, and you're going to make a lot of money. So then this is where that critical point is, that other traders see that bullish volume that come in. So sometimes you're protecting your position in this by buying at that lower price to get that average holding price down. But you might have to do quite a lot of volume. You might have to double. You might have to double down. And in that case, once a certain volume starts to come through, and we'll talk about volume in the next session, once that volume starts to come through, institutional traders start to take note, because somebody that's, say, slightly above break even sees that big volume coming in to buy, thinks I can get out here. I'm going to hold off. If somebody else wants to buy, I'm not going to sell at this price. I'm going to let it go up 50 cents and then I'm going to sell. And then if nobody wants to sell at that price anymore, and we've got that bottom coming in and somebody wants to buy, the broker has to put the price up. So then somebody buys at that price. And all of a sudden you found the bottom, and then nobody wants to buy, wants to sell at that price. I need to make a little bit more. I'll just hang on for another 20 cents, because that's human mentality. And then somebody buys at that price, and then it starts to move back up again. Because all a chart is a picture of behavior. That's all it is. And if you can interpret that behavior from a chart, you will succeed, in theory. Okay, trend failure. Trends do fail. Okay, so this is the other end of the spectrum. So if those traders in the slight loss maker position start to panic when the selling starts, they'll get out. But by getting out, they'll increase that selling volume. Yeah, and then everybody will start to follow. And that's when you get that trend failure. So selling positions to reduce their overall risk. They might be in profit in a really good trade, and there might be slight loss in this, but you know what? Let's get rid of those million shares. My P&L for the month's still good. I'm good. But what they do in that particular stock is continue that herd mentality down. Regardless, they don't care what's happening in the rest of the market. For them, in their P&L, they've got a really good couple of positions. This one's dragging it down a bit. Let's take that little loss. But by dumping that million shares, they start that move down. So then you see some of the early traders that see this sort of high bearish volume and continue. They decide to close the rest of their positions, taking the remaining profit. And that's when it really starts to go down. So, lots more traders sell and join the herd. And that's what happens. That's how the markets work. I like that failure. That's a watermelon. That's an epic failure, isn't it? It's one of those things you can just keep watching, isn't it? Okay, let me just take a drink of water. So again, a chart is just a representation of that herd mentality, that behavior. We've not even got to Elliott wave yet. We're just talking about the behavior. Okay. So everybody knows what a range is, but I'll just remind you, it's when it's going flat. very small up. Nobody wants to sell, nobody wants to buy, the small volume. You see how the average volume at the bottom below the range period there, it's very, very small volume. It's below the daily average. So there's no catalyst there to make traders think it's value. So there's no good news, there's no earnings, there's no tax reductions for that sector. You know, there's a lot of things going off, but nothing really exciting that an institutional trader. So yeah, you get that low volume there. Okay, then we got to move up out of the volume. Now, what I want to start doing is making this a little interactive with you guys in the room, and maybe the guys in the chat room, is trading is like, I'm an engineer, okay? So trading, in engineering, sometimes you have to describe the line of drive in a Challenger tank in 6th gear in an epicyclic gearbox turning right, okay? You've got to describe the observations that you see as an engineer in that process. A chart, traders need to be able to have that in the, obviously don't talk to yourself, but in your mind, you want to be able to describe what's going off there. What can you see? And by doing that repeatedly over and over again, you're training your brain to recognize patterns in volume and price action and within the trend. So we've had a big move up there. Tal, just give me one observation you can see from that move up in the price action. There's a gap up there, correct, okay? On that gap up, can somebody tell me what happens at the volume? You've got a massive volume spike, okay? But look at the candle after the gap. What color is it? So you've got a very high volume sell-off after the gap up, but look at the range. It didn't come and close the gap. So even though we had high volume, so what that was, those people that were playing the long game and bought in the range, when it gapped up, guess what? They sold, okay? They sold, but the high volume didn't drive the price down, okay? So you got a very narrow range. So they were block sells, okay? These were maybe one or two institutions that went, I'm going to double my money here, I'm going out, okay? But it didn't drive the price down. Why? Because there was a catalyst that made it come out of this range, and traders still saw value, okay? So you've got to tell the story in your head, what you see on the chart. It's a representation of what happened at that instance, okay? Next day, what happened? Big green candle, the volume was above average for the day, okay? So there was sentiment. So I call it a one-day wonder. You never react on the day of a gap or a bottom or anything. You need continuation. You need confirmation the following day. This is a daily time frame. Even on that big green day afterwards, I wouldn't have made a decision. I need that day to close, good volume, good price action, close right at the high. Brilliant, looking good. Then you can make a decision to trade the next day if you wish. Okay, so then we have a pullback. We have a profit-taking pullback. As you can see on this pullback now, we had a catalyst at the top, and we'll talk about more these in the next session, but you see at the top of the peak there, we get a little green indecision doji. After that, we get a big down day, okay? It's called a bearish engulfing. So then the confirmation of that the next day is it gapped down, and then you see the pullback. But look how the volume on average starts to peter off, okay? Recognizing that reduction in volume as we're selling off means that there's less sort of, I don't know how to describe it. There's people don't really want to sell that much. So the volume compared to when it went up, we're starting to contract. So there's no appetite to start to get rid of all your positions. So this is just a normal profit taking pullback. Yeah, it's not a sell-off. Now, one identification of that, at the bottom of this sell-off, you see this candle here? We'll talk about this in the next session, but it's a hammer, okay? It's a rejection. There's a massive wick. Look at the volume. It's much higher than the previous days. It's double. So they've rejected the price, the low price, with high volume. So it's gone, tested the lows. All of a sudden, the buyers have come in with more volume and started to push the price up. So it's rejected those lows. It's bounced off a table, yeah? It's bounced, and there's more interest. And then the following day, we get a green day. We never get a bigger volume day after that, but we get a green day. So in theory, we're starting to pull back away, the momentum starting to build again. And there we go. You can see that bullish momentum build, and the average daily volume starts to grow as well. So it's the price action and the volume starting to build that momentum, that herd mentality. And there's some big gaps in there as well, some big green candles. You see towards the end of that move, we get some really big volume days closing at the highs with gaps. You know, this is where the gaps are sort of pre-market, but this is where nobody would sell them some stock, okay, towards the end of the session. So what they do in pre-market, they offer more for it. The broker puts the price up and people take it pre-market, okay, and that's when you get the gaps. This one is quite a big gap there. But that's what happens. You get institutions going into the close, post-market, and nobody wants to sell at a certain price. And sometimes in post-market, brokers are not very prepared to stop pushing the price up too much. But in pre-market, if there's still a lot of buyers around that want that stock, the brokers will put the price up so somebody will sell it. For me, for example, because I'm in Europe, I can't buy or sell pre-market. You guys can. But you won't move the market. It'll be the institutions that will take that advantage. And that's when you see the gap ups, because during that pre-market session, there's a lot of buyers out there because there's some great momentum going. They want a good deal. No one's prepared to sell. So the broker just keeps putting the price up, the price up, the price up until somebody takes that order. And then that momentum starts and the market opens and you've got that big gap up. Then we get a pullback. Very similar, volume starts to contract. So it's not a sell-off, the volume's going down, the price action's coming down, but it's a measured move. And by a measured move is people are taking certain parts of their positions off. They're not taking the whole positions. Then we have another catalyst at the bottom here. Anybody know what that is? The pattern with the small red doji and then the big green bar. Bullish engulfing, okay? So you've got indecision day at the bottom of the pullback where it rejects the highs, rejects the lows, and you've got that little spinning top, that little doji. So there's indecision. So the next day is critical. What happens the next day? People think actually now, these institutional traders say, do you know what? This is a good pullback. I've got some good value here. From these highs, from that previous bullish move, I'm going to get in. Lots of volume comes in there, equal to the indecision doji day, but it gaps down, okay? Nobody likes that gap down. They see it as value. They start to buy and buy and buy and buy and buy. It goes up and you get that big engulfing candle there. But then you need the confirmation day afterwards, which happens. And we get a bullish move with a slightly new high. Okay. Now, I'm glad that's come on. I was getting warm. So, anybody see a wave count there? Anybody see a wave count there? Yeah. Okay. So that last leg was the fifth wave move. Okay. So 1, 2, 3, 4, 5. Okay. So before Mr. Elliott came along, that was just a trend. Okay. So what we want to do is try and identify that behavior and label it. And that's what Elliott wave does. So if we could measure that behavior in a consistent way with a set amount of rules and observations, we can pretty much say those fifth wave moves, trade the fifth, are high probability because everything has happened before, yes? The herd is following the path. There's a big herd of bison going through a valley, hitting a bit of rock, having to turn right, go back again, and then go, but there's water over there, yeah? And they've got to get to it. So they will find that path. Okay. So I am going to mention something quite technical now, and it's going to get worse during the day. I do apologize, but we have to do some technical stuff, okay? It's not all about buffaloes and jumping off cliffs. So we can use basic Elliott wave rules and observations to measure and track trend progress, okay? Now, some of you have seen this in the boot camp, so we're going to just re-go over that now. But I wanted to give you the picture and the behavior of where we get to that you see in the boot camp, because that's important to be able to describe. And yet, if you're on your own at your trade station, just talk it out loud. It doesn't matter. Describe what you see. And that's the important thing there, because the chart is just a representation of what was happening. So we need to keep it simple. A lot of people overcomplicate Elliott wave, inner waves, inner waves, just 20 different fib levels. It's pointless. It goes up, it comes down, it goes up, it comes down. We need to measure it, yeah? So we're going to talk about three basic Elliott wave rules that we follow. 3 observations of the behavior for measuring the trend with Elliott waves, building a picture of high probability. You're cold, aren't you now? I was getting really hot then. I'm glad that aircon kicked in. Okay, so we want to put it together in the form of a simple, repeatable strategy to trade the fifth wave of the trend. Again, everything's happened before, yeah? So the probability is going to happen and hit that fifth wave. So why the fifth wave? Again, because all the rules and observations have been met during the trend. So we are not the only people that use Elliott wave. You've seen my institutional grade software. It prints Elliott wave counts, okay? So institutional traders look at that pattern and they will trade that, well, they trade the third and the fifth wave, but they will see that pattern starting to occur, and that institutional grade software will say, no, that's a wave 4 pullback. We need to start getting in. And they'll drive the market up on the fifth wave. We'll just get in for the ride. We'll get a bit later, but it doesn't matter. Okay, so trend rules can't be broken, okay? So rule 1, the wave 2 must not retrace further than the origin of wave 1. Sounds basic, but when you're looking at a chart, you need to see that that first impulse leg up, the wave 1, when the wave 2 pulls back against it, it doesn't go below the origin of the start of that trend, of that wave 1. If it does, it breaks it, we're into a correction. We're doing that this afternoon, correction, okay? So we've got that wave 2, that first rule, the wave 2 must not retrace further than the origin of wave 1. So wave 3 cannot be the shortest of the 3 impulse waves. Okay, let's say 90% of the cases, it is the longest, okay? It depends on how much momentum builds in the first wave, but it will not be the shortest. In a lot of cases, the fifth wave, once it gets longer than that third wave, our software will reprint it a wave 3. So when people say, how do you get in a third wave? You just get in a fifth wave. And when the momentum blows through your target, you're in a third wave when you're on your way to the moon. And that's what happens. You've got to be in it to win it. Yeah? So you've got to be in it to win it. So rule 3, wave 4 must not pull back beyond the wave 1 extreme. This is important. That profit taking pullback, if it pulls back below that wave 1 extreme, the trend has failed. It's pulled back too deep. The profit taking's gone too far. The herd is going now. You can put the brakes on, it's really difficult. So that's That's critical. So some observations now. Now these, they're not rules, they're observations. It would be nice. But in reality, I won't trade anything in these current markets unless all my observations are met as well. Okay. Because we're not trending by no way means. So you will notice this looks something like the Elliott wave indicator suite with our pullback zones. And this is how we measure that wave 4 pullback. Okay. This is how institutional traders measure that wave 4 pullback. And these are our probability zones. So we get that wave 4 pullback between 0.25 and 0.382. If it finds support there, there's an 85% probability it's going to go on and make that new wave 5 high. Because it's a very shallow pullback, but it's measured enough for people to think, you know what, there's some good value there, let's go. Yeah? Just to explain yeah, they're all Fibonacci levels. Now, 0.25 isn't the fib level. It's 0.2389 whatever, okay? But all I do is round it up to 0.25 because I'm conservative and I wanted to go a little bit deeper. Because sometimes you'll get to the 238 and it just starts to go up again and it fails and you get that complex wave forward, it comes down again. So 0.25 is not an exact fib level, it's conservative and we've just gone down a little bit. 382 is a fib, 0.5 is a fib and 0.618 is a fib. They're Fibonacci retracement. So it's a retracement of that impulse leg, that third move, third wave. So between the 382 and the 0.5 is an 80% probability, okay? So it's gone a little bit deeper. We may have had a little bit more volume. Again, we're just trying to measure the behavior here of human beings, institutional traders. So we've got to give it some rules there. So now 0.618, that's your last chance saloon. If it goes too deep, the momentum will just pick up and go straight through. Now, some people trade wave 4 failures. They're not easy because sometimes that turns into a correction and can go sideways. So you are basically rolling the dice if it goes below that 0.618, that red zone. And that's why I colored it red on the indicator suite. If you go through that red zone, you're most likely either going to shoot down or go corrective. It's not a high probability move. It just makes you throw away that ticker for a while because it's no good to you. It's not met the rules. Okay, so observation 2, we use the 535 oscillator. A 535 oscillator is actually just a histogram, a picture of the cross-sectional area of a 5 moving average and a 35 moving average. Instead of having it all cluttering up your chart, we put it in a histogram. And there's a rule. The wave 4 must pull back between 90 and 140% of the highest point on the wave 3. That's the rule. Well, it's an observation, but for me, it's a rule. If it breaks it when we're not trending, you don't get in a trade. You see how that one there, it was a really nice pullback. It crowned, started to pull back up again, and then the 5th wave started to move. So one observation I've not written about there. You'll see on a 5th wave move, there's less intensity on the oscillator. So a 5th wave move won't actually get as high on the oscillator as the wave 3, okay? If it does, it's most likely to continue and reprint a wave 3. So you can use the oscillator to gauge how powerful that 5th wave move is. Okay, stochastic. A lot of institutional traders use 2575. I'm English, I'm conservative, I use 2080, just to make sure that my oversold zone is a little bit lower. So I've got a good pullback, or my overbought zone is a little bit higher. So I use 80-20. So, you know, we're starting to combine these now. We see the 535 oscillator pulled back between the 90 and 140. We've got on the new version 3, which you should all have, we've got the false breakout dots on the top in the overbought zone there. Those denote really strong bullish momentum. And you've got to think of on a wave 4 pullback, it's pulling back against really strong bullish momentum. It's like an elastic band. It just wants to return to the overbought zone, okay? And that's what it did here. So when you get that pullback and it crosses over in the oversold zone there, it's likely to want to return, okay? So yes, it's a lagging indicator, but when you're starting to build the picture of putting all these together, of seeing how this behavior is starting to work, you know, that elastic band can break, and that's when you get a wave 4 failure, and it just continues in the oversold zone. But if it starts to cross over and starts to come out, you then see the 535 oscillator crowning start to come lower towards the 0 point. You're in your wave 4 pullback zone. You're starting to get a really good sort of feeling that this behavior now has found a bottom and it's starting to pull back up again. So we put it all together. So we've got a checklist. When I first started this, I didn't have a spreadsheet. I printed off, using company paper, a checklist for every trade. I had 3 trades per A4 sheet paper, and I had a checklist on the bottom, and I'd check them all off, okay? And I put my entry, stop loss, and everything like that. We're in a garage somewhere in England. There's a big box for every trade I did. So, you know, we got this checklist, and they all must be ticked for an entry. So we've got our rules, we just talked about, and we've got our observations. And again, it's on a computer now, it's a lot easier because we've basically built the indicator suite. You know, it's in the red, the green, or the amber zone. You've got the 535 oscillator, got stochastic. But for me, I always used to do ticks, but you need them all there. But what next? Still not there yet. We've seen that the behaviors met our criteria, but we need to find a trade. It's an entry. So keep out. So the important part, we need a simple and repeatable entry strategy with a minimum risk to reward, okay? You can do all that good hard work. If you haven't got a decent risk to reward to your target, you don't get in, okay? Because this strategy relies on a certain percentage win rate. So if your average win rate is, say, 1.2%, but every time you lose, it's 1%, you're never going to make any money. But if your average win rate is 1.6%, and even if you got your 50% win rate, losing 1% of the time, you're going to make money. This is why you only get in trades with a decent risk to reward. The ones that aren't a decent risk to reward are going to drag down your average win percentage. Okay, so entry strategies. So for going long, we use the 6-4 moving average high for long entries. Why do we use that? It's a conservative entry. It's a leading moving average. So it takes the highs of the last 6 candles, and it projects them forward by 4 candles, okay? So in theory then, you are reasonabably conservative going into a trade. There's other factors that we'll talk about later, but this is the basic strategy. Because if you were to put a regression trend channel on that 4th wave down, you would have got in that a lot earlier, a lot more aggressive. Now, when you're in a trending market, which we are not in at the moment, you can do that. So 2013, 2014, I was using regression trend channels for everyone. I was going really aggressive, getting in and winning loads of money, okay? At this moment in time, I don't use a regression trend channel, or hardly ever. I use a more conservative 6-4 moving average high entry. And then the same for the lows. Now, with this low, I'd use this as an example. We want to go below the 6-4 moving average low, but you see my entry is a lot lower than that. Can anybody on the live streaming tell me why I've gone lower than the 6-4 moving average high? It's not a test. I wasn't peeing, it was water for those live streaming. Anybody? Nobody? Okay, anybody in the room? Yeah, the price action here. You see these lows where the indecision doji is, they're all at a big support level, okay? So the price, the institutional traders, i.e. the brokers as well, tried to push it down. It failed, okay? Somebody saw value at that price. Yeah? No, we don't use the Bollinger Band. We're just using support and resistance. We're using previous price action and very recent price action. So when I use the cursor, we see these three candles here. The first one rejected the lows where the cursor is and shot back up again. So that was a price in which institutional traders saw value. So they pushed back up from that price. Do we really want to enter at that price or just above it? Because if you just get in short, people see there's a great value and it shoots back up again. The next candle was a green candle. Where are we? But it actually rejected the highs as well, okay? So there's a lot of indecision in the market right there. The following candle was a big full body red candle, but still didn't push through that support level. The following spinning top rejected that same level again. So this is the talking to yourself in your office comes in. Oh, I'm not going to go in above there because my 6-4 moving average is above there. If I get in above that support level, it's only a short-term support level, but on 3 separate days, people saw value and rejected those lows. So in your mind, you are not going to get in above that price. Yeah.
Do they ever play games with you where they set you up or they make you think that there's a support or resistance and they just cut people in and take it out?
A lot of conspiracy theorist traders in futures thinks that happens, okay? In reality, the only people making those candles moves are institutional traders making decisions for themselves and their company.
So not the market makers?
Not the market makers, no. Because if somebody wanted to sell a lot at that price and take some profit, the market makers can't stop them doing that.
But I've seen them when they hold it in a range, like you can tell they're dumping. And then once they're done dumping, it just goes.
Yeah, but it's not the broker that's dumping. What's happening is people are buying and selling at the same price, okay? And sometimes that's an institution. The same institution, the guy next door, okay, he's selling one from his holdings and the guy's buying it at the same price, okay?
Well,
they're just basically in the same company, but he's offloading some of his holdings to his mate who needs some apple. Okay, yeah, so it's not, they're not driving the price, it's that his mate next door is not doing very well, he wants to take some profit. No, they can't do internal, they've got to do it through the market. But what we have to see is we just have to look back and think there's been some rejections there. If I went in short just below the 6-4 moving average low, I could get wiped out here, it'll just bounce again. So you've got to make sure it goes below that rejection price. And again, I call them decision points rather than support and resistance. It's a point in which institutional traders have made a decision. Yeah. Now, we can't exactly get into their minds what those decisions are. All we can say is that's a critical decision point, and we want to make sure we're short below that. That's the thing to learn from there. Absolutely. Yeah. Yeah, I draw them on manually. Yeah, we can't automate it because it's something that's personal to a trader. So I can teach the 6-4 moving average low as an initial entry, and I can teach where I would think a good entry is, but I can't automate that level because somebody might be more aggressive than me. Somebody might see look further left and see that rejection as a support level. So they may draw their green line there. So with this strategy, it's down to the individual to draw those green lines for entry. And the reason I mean, some people don't draw lines. I draw green for go and red for danger. Yeah. And I've always done it. You know, you don't need to, but I always draw them in. And I think it's good representation when you're trying to teach people that the green is where you go. You know, that's where you go, where you buy or sell. But no, they're not automated, and we will never automate them, because at some stage, somebody has to be and make their own decisions for their own entry. All I can do is guide people to do that. So, final ingredients. Stop loss is slightly beyond the wave 4 pivot. Okay, so there's no set rule for this, but if it's $100 stock, you're not going to go 1 cent below the wave 4, are you? Because you get this lag in response to price. So if it's $100 stock, you may be 5 cents, 5 to 10 cents below the or above the wave 4 pivot. If it's a $200 stock, you need to be at least 10 cents. If it's a cheap stock under $20, 1, 2 cents will be fine. Okay, because it doesn't move that much. But if you've got a $2,000 stock, okay, you've got to think you're going to be 25, 30 cents below that, even a bit more, because brokers they're reacting to the consumers, if you like. They're reacting to the need to buy or sell. But that reaction becomes when no one wants to buy something, okay, or no one wants to sell something. So they have to adjust the price. On a $2,000 stock, they're not going to adjust the price by 1 cent, are they? They're going to, because nobody will go, oh, it's not worth it for me. I'm not going to sell 1 cent. You know, you've got to move it more than that. So move it 10 cents, nobody sells. Move it 20 cents, nobody sells. So all of a sudden, you moves it 50 cents and you're taking out your stock because you put your stock 2 cents below on a $2,000 stock. So you've got to think what the broker's going to do. If you can't find anybody, if somebody wants to sell a particular stock price at a certain price, but nobody wants to buy it, he's got to reduce the price. And if it's a large value stock, he can't reduce it by 1 cent. If it's a $16 stock, he could move it 1 or 2 cents and people will be interested. But the more expensive the stock, the less likely somebody is to see a 1 cent move and say, you know, no, not enough there for me. So target zone. Now, I put this in, and this is how we measure our target zones. In reality, there's a few other things, but basics. The target zone is between 120 and 140% of a Fibonacci extension from the wave 3 to the wave 4 pivot. So what you do is you start at the wave 4 low, for example. You click once on your extension. You take your fib level to the wave 3 high. You click for the second time. Then you bring it back to the wave 4 low. Click for the third time. And then you just need to adjust the 120, 140, and that's where your target zone is. But we automate that anyway. But that's just a manual way of doing it. And a minimum risk reward of 1 to 1.6 minimum. Okay, not 1 to 1.4, 1 to 1.6. You've got to be extremely disciplined. The 1.1, the 1 to 1.6 can be the top end of your target zone, the 140. But if you've got less than that over your month or quarterly or the yearly, your average win percentage is going to be too low, because you will get instances where you'll take a lot of losses and they're all 1%, 1%, 1%, 1%. Okay. And if you get down to that 50-50 and you're only making an average 1.1 or 1.2 win, you're never going to get ahead. Never going to get ahead. So walk away from the trades that don't have the good risk reward. Okay, so putting the whole picture together now, this is the Ninja Trader Suite, but it looks the same on everything else. We're going to put it all together with a simple strategy. So we've got the pullback zone there, the wave 4. It's just dipped into the amber zone, as you can see. It's found good support, liking it a lot. The stochastics pulled back against a false breakout bar. It's crossed over in the oversold zone. And the 535s within 90 to 140%. So we're building that picture of that herd mentality, finding support. It didn't keep going, yes? All of a sudden, they've turned the corner and they're starting to go back up again. And you've got confirmation of that with those 2 last good green candles there. So again, smiley faces. Yeah, this is you talking to yourself in front of your computer saying, 535, check. Stochastic, check. Pullback zone, check. I need an entry strategy. Where am I going to go? Wait for that day to close, the last day there, closes at the high, most likely good volume. I'm going to go above the 6-4 moving average high for the next day's bar position. Gone, done, simple. That's your entry strategy. Put your order in. Now, when you put an order in for a stock, if you're not trading options and you're trading a stock and you want to go in at, I'll read that now. I need to put my other glasses on. I can't even read it. So 185.25. Yeah. So if you want to enter at 185.25, it's an expensive stock. So you put a stop limit order in. You can't say, I want the broker to take me in at 185.25, otherwise I'm not interested. It won't work. Because, again, it's an expensive stock, and he will keep putting up the price until somebody wants to buy. And you're only a little retail trader, okay? So you won't matter. The institutional traders will matter. So $185 plus or minus 10 cents will get you in that trade. Yeah. If it's a small stock, plus or minus 2 or 3 cents. But when you put a stop limit order in, you've got to put stop limit order in. If you just put an order to buy at a specific price, you may not be taken in because you are not a priority. Okay. Priority is the person that wants to buy 500,000 shares. Somebody that wants to buy 10 shares, you don't matter. Okay. You just get the leftovers. Okay. So that's why you need to put that range when you're buying the stock or selling. Okay, we've got a stop loss just below the wave 4. It's $185 stock, around about 18, 20 cents. We've got an entry. We've got a target risk reward of 1 to 2, just to the lower end of the target zone. Looks pretty good to me. And zoomed in now, you've got that risk reward 1 to 2. So everything stacked up. It's a good high probability trade. Yeah. And all you've done is you've seen that nice big move up, that herd mentality driving that price up. You've seen some profit taking pullback. You've seen that run out of juice, seen it turn a corner. You've used our Elliott wave indicator suite to measure that wave 4 pullback, the 535. I keep mentioning it because that's got to go through in your head all the time. Check, 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 check. Last thing, risk reward, sensible entry strategy. That's my order. Put it on, fine, forget. Okay, so entry strategy short. So I've basically put, from what we talked about on those little ones on those slides, put the whole charts together there. So you can see there, that was it was a messy wave 4 pullback. There was a lot of indecision going up there against the short. You know, you see some of those big green candles thinking, no, it could have gone, keep going, could have got a wave 4 failure. But then somebody put some news out or an SEC filing, something you can't predict, and it just returns to the main trend, okay? But we've got to be sensible with that entry strategy, got to be below that, that sort of short-term support level. 535 is good, stochastic's good, got the false break on there, everything looks good. Now, this can all look good, but because of your conservative entry strategy, if your risk to reward is below 1.16, you don't get in. You don't adjust your entry just to make it 1 to 1.6, because your initial entry strategy, you shouldn't have the risk reward in your mind. You should have, where's the sensible place to get in this, okay? Your risk to reward is your last measurement. To be honest, it's your last line of defense from losing all your account balance. So there's your risk reward. That's good enough, 1 to 1.6. Now, I say 1 to 1.6. You don't have to risk 1% of your account balance for every trade. It's just the risk to reward ratio. I risk 1% on swing trades. I risk anything from 0.2 to 0.5% on a day trade, okay? But it depending on your account balance, the margin availability, your capital that you've got left in your account, all that sort of stuff, you may be only risking 0.2, 0.5% of your account balance per trade, but it's the risk to reward ratio that needs to be measured with that fib extension. And it comes down to where in the world you're trading, what instrument you're trading, and everything like that. Now, what we will do next year is we'll put together a course specifically for options traders for trading options when you're swing trading. Jerry will do that, not me, because he's the option master. But we'll put that course together because, you know, in reality, unless you've got $400,000 in an account, you can't trade physical stocks with this strategy once things start to really get going. You can't. For me, I trade CFDs, so I can have 23 open trades and still have loads of margin available.
What about if you use options anyway? I think it's up to boring. But what, it's too much risk for us. You got to, like you said, 200,000 to make $2,000, 3,000. You're gonna have that much in your account, right? You're
gonna have quite a bit of money in your account, yes, yes. Yeah, yeah. Unless you've got a big account balance, and this is why we're going to do an options trading course, but that needs to be by somebody that's been in the trenches. Yeah, yeah, yeah. Yeah, yeah, yeah. There's not a lot of volume. Yeah, yeah. NQ and ES is on our, yeah. We'll be doing those. That service will start in January.
In options, the third party, how much the option will move when the stock moves, right?
Yeah.
So you can buy 50%, you know, the target says you can buy even 30%. So if you buy like 70% data, it's like almost you're buying top.
Yeah,
and
yeah.
The strategy works perfectly.
Yes, yeah, 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 yeah.
You buy like 2 months out. 3 months
You've got to, because usually a fifth wave trade in normal trending markets may take anything from 9 to 20 days on a daily time frame.
Yeah.
Now averaging, I'm seeing 35 days, sometimes longer. So you've got to go further out on your options to actually make it work.
No, I'm taking your stuff. Like, I mean, you're doing the whole stuff.
Yeah.
I don't use that about $500,000 in my accounts. I don't use all of it. That's like say it's 100,000. Sometimes go to 200,000 in the options.
Yeah.
But I'm playing with the rest of my money. I'm playing some of your stuff small.
Yeah, 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 yeah.
That's like gravy for me. I don't have to do the homework. I just whatever happens, I'm still doing my.
Yeah, yeah, yeah.
Yes, right.
Well, my inner circle, what I try and teach them is that 35% of your account balance should be in physical stocks, in growth stocks, and you're buying on the dips. Okay. Long-term investment, so 5-10 years outlook. So the Apples, the Googles.
I'm a real estate guy, so my money's the real estate.
Yeah, yeah, yeah. Yeah, yeah, yeah. But then, so then then take 15% for day trading and 50% for swing trading, because it's like say a race of 3 different athletes. They're all going to get to the finish line at different stages. So you've got a 90-year-old grandma in your 35% on your long-term swing stocks. Yeah, she's going well, and she'll get there. Yeah, she'll get there. Then you've got your day trading, which is Linford Christie. You probably don't know him. He was an English athlete. Okay, he gets there straight away. Yeah, he makes you some money. And then you've got somebody like me, 50 years old, ex-military, bit of a belly, and I'll be just beating the grandma, but I will nowhere keep up with it. So you've got those people at the finish line disloyal, and that's how to stay consistently profit and trade as a business. You can't put all your eggs into one basket. So you can't just trade options and think you're going to earn a living. Yeah, you can't swing trade and think you're going to earn a living. What you've got to do is have those three strategies moving along, and I call it my sausage machine strategy. So you're putting those ingredients in, you're turning the sausage machine, and you're coming out winner, winner, loser, loser. Yes, yeah. You'll see my results this month when they come out. I think I made, it was on the swing trades, 260%. On the day trades, 2,500%. Okay. On the inner circle, 650%. But our blend's not counted in that because I don't share that. But the idea is, because you've got those three different athletes every month and every quarter, you're consistently making money. So if swing trades are hard at the moment, they're difficult because of Trump, tariffs, and everything else. It's difficult. But what you can do is, especially if you've got like 35% in a blend, okay, and you've got Netflix, for example. I've got Netflix. I've got quite a few positions, and I got in quite low. But it's had a big, steep pullback. So what do? Take some of that 15%, sell it short. Okay, we made, in the inner circle, we made 4.6% profit on the account balance in a week going short against our main investments. So what do? So it's insurance, but we then keep hold of that money. When things start to turn back up, guess what we do? We buy more in that because they're lower, and we start to increase our holdings. So it's all just, it takes a lot of practice and quite a lot of guidance in some cases, but it's just keeping that momentum going. It's a business. It's a business, yes.
But looking at the cycle, you guys don't think that at some point in this late cycle, you need to take some money off the board? At some point, this is going to happen and keep going.
Yeah. But what was?
Oh, yeah.
Oh, right. Sorry. These AirPods aren't very good then, are they? So what was your question again? Sorry.
Look at the fact that historically, at some point, you have to take some money off the board.
Yeah.
This market is just can't continue on going.
No, but at the moment you don't panic because you look at the herd mentality. So for those on the live streaming, Brian asked that do you start to take money off the board as in your physical holdings as things go? But no, we're not going to have another 2008 is the answer, okay? Because economy's reasonably good worldwide and in the US. So there's no sort of major reason or catalyst for everything to sell off. At the moment, it's reactionary. It's Apple has led the market just like recently. So you've got to don't think of the economy or anything else. Somebody said Apple has reduced their orders. So what does Apple do? Sell off. Apple is a massive constituent of the S&P 500. So everybody just starts to cover and it drives the market down. But we're starting to see some sort of support. We're not seeing that herd mentality continue. When we go this afternoon, we'll look at the Apple chart and we'll look at the volume. You will see the average daily volume at the moment on this sell-off is a lot lower than previous, okay? So you've got to look at that price action and volume together and make those decisions. Yeah. Overall, what you could do is you look at your blend portfolio, for example. For me, I look at my blend portfolio. Some of them are in profit, some are in loss. Some of them are below those original entry prices. At the moment, I'm covering short, doing those short trades, insuring. So at the moment, I'm balancing it out. So if something does go wrong, I press the parachute button, sell all my shares in the blend, and I'm still break even. So I'm trying to keep that balance at the moment. If I start to see the balance go too far, I'll press the parachute button, but I'll still then keep trading short. But the idea is with a blend investment portfolio is to have the balls to hold it down low, wait for it to come back. So for example, I think Netflix I've been in at 100, 160, that sort of thing. So at the moment I'm still in profit, okay? So, and it went up to, what was it, 400, something like that? So, I'm still holding. I'm still holding. Even if it comes down below some of my original entries, I didn't sell because for me, it's a longer term. You know, I've recently shorted on a different account, Netflix, and it looks, and it was a good trade. So I will hold on to that cash. Yeah. Yeah, because they're going to run out of juice at some stage, so you've got to be careful. Right, let's just finish this off. So the strategy is now complete. So remember, risk to reward, minimum 1 to 1.6. If you haven't got it, the trade is no good. I'll reiterate the checklist. Some people like the sort of feeling, the touching feeling of actually writing a list, printing it off and ticking it off. It's a procedure, it's the motion that you go through. And I went through it for years. For now, it's here. And the reason I developed the software is because in theory, you've got these big colors and, you know, they're all there. But if you like checklist, do it. If it helps you go through the same routine, because it's you've got to repeat the same thing every time. Otherwise, you're going to struggle. So again, do your checklist. Or do it on a computer. Some people are quite tech savvy now. They can put a checklist on a computer. But the only thing I would say is you just got to repeat it over and over again, and don't break the rules. Be disciplined. Yeah, it's like a soldier or an athlete training. You repeat the same thing. So if you're throwing a javelin, you don't throw a tree. You practice and you throw a javelin over and over and over again. And sometimes you actually get it better by changing your stride or your approach. You'll change the trajectory of your throwing the javelin because there's a certain amount of wind or whatever. That's market conditions. If market conditions are changing, you're going to change your run up, if you like. You're going to be even more strict on the discipline. And you might say to yourself, it's going to be 1 to 2. You're going to change things to account for market conditions. Okay, so that's the core trading strategy. You try trading with a trend. So what I'm going to do now is I'm going to stop the recording and take a little break. What time have we got now? That's good. Then we'll go on to the next bit and we'll talk about price action and volume at those wave 4 pivots and things like that. And there's certain patterns and things to follow through to recognize really good high probability trades. So let's just stop the recording. I'll stop because then it'll load it up to the cloud. Okay, guys, those that are live streaming, I'm just going to take a 5-minute break and then we'll carry on.